So we can talk about broad market, right? So if you
Yes.
say the industry works on 12-13% CAGR returns, factor baskets have outperformed the broad market 100% of the times. Will you pick all Virat Kohlis? Will you pick
No.
all Rohit Sharma, or you would need all kind of players? You will need all characteristics in your team. So you can relate that to macroeconomic conditions. Apart from your core vanilla Nifty 50 ETF or index you do, I think everybody should start thinking about the strategy ETF.
So someone is doing all the hard work for you.
Somebody is doing
You
the
just
hard work
need
for
to
you,
take
machine
them.
is doing the hard work for you, and ultimately you take the final meat. Unfortunately, in our country, there is no ETF. There is no index fund which kind of using this as a base. Only one fund house out of 43 fund houses in the country has issued only one ETF in the country. That is the entire notion of Nifty Alpha. Low volatility is less risk does not mean less returns.
Hi Robin,
Hi,
welcome to PowerUp. Let's get started right away. Let's start with a little bit about your background from being a software engineer to now managing crores of money.
So I'll kind of take you back to 2008. So my first internship introduced me to the markets. It was a Citibank project, and then 2009 I landed up with a paid position at HSBC, where of course the journey kind of began, and I continued that journey for 14 long years. So 11, I think I opened my Sharekhan account as the first Demat account, and I think that was the first exposure to kind of invest directly. Also along the way, did my master in quant finance. Done a lot of work in factor investing from 2018, doing a lot of work in algorithmic trading.
Perfect. And how did your interest in finance start?
I think number game is always when you are a mathematics student or analytical student, and when you are doing data crunching at your job, so a lot of academic interest started to build, and I started reading a lot of research papers on factor investing. There's a lot of research done from very pharma French 2-factor, 3-factor models to modern portfolio theory to capital asset pricing models. So a lot of things have done by academicians. So that's how I think the interest came along. When you make money, you say, yeah, this is working for me. And
Right.
if it is working for me, I'm sure it can work for others as well.
Perfect. And I'm very curious to learn more on factor investing today. Just to start off, right? Typically, so this is an investment strategy that investment strategy or stock picking strategy that helps deliver certain alpha. What's
Correct.
like the kind of range of returns that one can expect here?
So we can talk about broad market, right? So if you
Yes.
say the industry works on 12-13% CAGR returns, factor baskets have outperformed the broad market 100% of the times. In 10 years, right? If you get that 3-4% extra, right? Maybe 1,000 can become 3,000 in 10 years with a 12-13% return. But with a kind of a 18-19%, 15% return, it can be even 4,000, it can be 6,000.
Yeah.
Right? So the kind of compounding effect you can see.
So I'm sold on learning more on factor investing. And on that note, I've seen a lot of your videos where you were explaining factor investing through cricket team.
Okay.
So I got, a team picture for me to, and for our audience to understand what
Okay.
exactly it is. So I got this picture with me.
You have to decide to form a team, right? And this is a World Cup team. Now tell me, will you pick all Virat Kohlis? Will you pick all Rohit Sharma or all Bumrahs, or you would need all kind of players? You will need all characteristics in your team. You will need players who can play spin. You need players who can play red ball, white ball. You are playing domestic, playing internationally, how the pitch is. So you can relate that to macroeconomic conditions, that you're playing internationally, domestically, how will be the pitch, you're playing test cricket, short form cricket. Accordingly, you will decide which batsman, accordingly you will decide which order they will play, right? So multi-factor is something which is beyond one factor. If you look at any broad market index, say Nifty 50, right? Which is the highest weightage in Nifty 50? For example,
HDFC maybe?
So the name we are taking is just for reference,
Yeah.
no investment advice. So if HDFC would move at a greater extent, your Nifty 50 would move, right? Same happens when people invest in 5 mutual funds. They think they are very diversified. They've invested in 5 active funds. They don't realize that they actually invested in 5 companies only. So the entire money is going to 5 companies. If those 5 companies are not moving, ultimately, they are having a hard luck. So what happens in a factor concept, you think beyond one factor, which is size.
Okay.
Here only size is a factor. Bigger the company, higher the weightage, right? That's how new companies get added to Nifty 50 or Nifty 100 baskets. Here we are using some kind of very clean factors.
Okay.
It could be, say, quality as a factor. Quality could simply mean very good balance sheet, good cash flows, good return on equity. You may think of momentum as a factor. That's something, somebody who's kind of in a form, in a match. We are expecting that person to be in form in that city, right? Because the form is there. And then if the price is moving, it is in momentum. PSUs, defense, railways were in momentum last year. So the expectation is it will continue to move unless some external kind of friction will let it stop. Otherwise, the momentum will continue. Alpha is more of a statistical concept called Jensen's alpha. It simply means that how much the instrument can generate excessive returns over the estimate returns. For example, you may deploy some standard mathematical models, say capital asset pricing model, and you may think that this company should generate X percentage, but the company is able to generate additional excessive returns, something like Virat Kohli. Right? Virat Kohli will always beat his own average because he'll get better and better. And then alpha, momentum, quality, value. You want to find companies which are available at very, very cheap price, at right value. Otherwise, you may get stuck in there for 3-4 years. So if you think about this team, right, think about Virat Kohli as a alpha plus a quality player. Because one quality will not kind of help you sustain in the team. You need to have two qualities. Right now, alpha is not performing, like what Virat Kohli is not performing. Alpha as a strategy is also not performing because it is a high volatile strategy. So what you can do to it on the books, Virat Kohli has wonderful stats, right? All check pass, all quality parameter pass, and he has the ability to generate alpha for your team, right? So that's alpha quality as a combination. Think about now you want to add volatility. Think of Bumrah here. So he is alpha, right? He will be alpha for team, but he is low volatile. He will not end up getting hit too much in his inning, right? He brings that alpha quality, but again with a low volatility. Think of Rohit Sharma. He is a momentum player, right? He would just go out, play his natural inning, go big. So that could be momentum. Think about say Hardik Pandya, very well all rounder, kind of can play, can bat, can bowl. We have something called, we can mix of volatility plus say value. So you can kind of combine these two factors. There are new players coming. Of course, your Surya Kumar is again a value and momentum. So he can actually come and play very unorthodox shot, right, around the kind of all corners and still brings a lot of value to the team, right? So that's where value and momentum can come. And think of player like maybe Archdeep and these are all new growing players. So when your company's EPS is growing at 20% CAGR, right? You of course they might be volatile. They may get out or they may not do one of the good innings, one of the good quarter, but they ultimately are in growth phase, right? They are growing companies. So that's where to make a successful Dream 11, IPL or a world-class cricket team, you need all factors in the right combination and keep rebalancing basis pitch, basis test cricket, basis one-day cricket, and accordingly you can choose your baskets of stocks.
Right. So Robin, I think factor investing as an investment strategy seems very exciting, and I would love to, sort of do like a step-by-step approach of if a retail investor wants to invest using this strategy, how should we approach it? So over to you now.
Absolutely. So I'll give you a demo from a public website. If you go to the website called Nifty Indices, right? A fantastic work has been done by NSE and the entity which maintains these indices to kind of create not just broad market indices. We talked about like Nifty 50s of the world or theme based, but strategy based, which are here. If you go to the section, you go to strategy indices. So you can pick any of these strategy here. Maybe you can start with Nifty Alpha 50. We will maybe cover two strategies where the instruments are available for you to kind of get exposure in markets today. Whether it is index funds or ETFs, that is one of the cleanest way. Apart from your core vanilla Nifty 50 ETF or index you do, I think everybody should start thinking about the strategy ETFs or index funds, and of course more complex products. Once they kind of mature, graduate in their journey, they can think about multi-factor and all of that. And if you just simply open fact sheet, that becomes your source of truth. This get updated depending on the cycle of the rebalance. The sheet gets updated usually every month, but the basket gets rebalanced every quarter. So for a retail investor, he only has to think from the perspective of top 10 companies, right? He doesn't have to think too much. He has to see this once a quarter, 3 months later, see the difference, and he will find that out of 30 companies, 10 are dropped, 10 new are added. That is where the alpha is. And alpha will remain for a good period. It will remain for 3 months, 6 months, 9 months. Plus, these companies have come after a lot of checks and balances, whether it is about their balance sheet, fundamentals, liquidity. The fantastic part is all that kind of things are done here. So this is the final set which is prepared by the exchange and gifted to you. You can see the top 10 companies with their weightage. You can see that right now alpha is in capital goods. So what they can do, they can check this. They can again come back to the same page, make a list. They will usually find a good level of churn Sometimes 50% portfolio get updated, sometimes 5 companies will get added. That's one way. Now, if you look at the kind of return, of course, we do not want to talk too much return, but you see the kind of return from inception, 20 years CAGR return. That's what, not even doubling every 4 years, even much lesser than that, right? If you think about 21% CAGR returns from inception for this basket. But of course, this basket comes with more volatility. I'll show you another website, which is India Passive Funds. Another fantastic website, I think launched maybe less than a year ago. Great work by, again, the exchange here. They can go to screener. They can simply go to underlying index and say alpha. I'll just quote one example of say alpha,
then
right?
This is required for me. So Nifty Alpha 50 is a set of 50 stocks that has been picked basis their alpha,
basis their alpha on the entire NSE universe. Of course, with a lot of conditions being passed around, liquidity, volume, last 1 year of history. Right?
So it's a curated basket already available for you.
And then when to exit as a retail investor, what to add. That is also they are supplying you every month, every 3 months, right?
Right.
So that kind of give you a constant learning opportunity that where is the alpha, and alpha is one factor. Similar thing happens for momentum baskets. Similar thing happening for value baskets.
Yeah, the 6 parameters that you
all the parameters we talked about. Right? So there's a basket called Nifty 500 value 50. So out of 500 companies in India, which 50 companies have the value, with the right value? They make sure that they check P ratios, PB ratios, EV by EBITDA margins.
Yes. So someone is doing all the hard work for you. You just need to take
Machine
that.
is doing the hard work for you, and ultimately you take the final meat. So what you do, you take the underlying index, you apply kind of filter. You realize that in India, out of 125 ETFs which are there out now, I think only one fund house. There are 43 fund houses in our country.
Yeah.
Right? And out of the 143 fund house, only one fund house Kotak has launched a alpha based ETF, which is not a great state of affair right now. When I speak
and this by ETF means that I can go to my
broker
site and I can
just search
and I
for
can
example,
buy
if you click there, if you just search alpha, you will find this ETF. Just buy. It is right now only 440 crore rupees of people money in this kind of basket. It will try to replicate the Nifty Alpha 50 basket. Right? That is the logic. If you want to go via the index route, you can always go by index route and by coming over here and seeing that there's a Bandhan mutual fund which has introduced this basket. Now we can talk about, I mean, I would like to, you emphasize here on multi-factor because of course alpha, you have seen that kind of returns, right? Doubling money so fast. But of course it comes with volatility, it comes with drawdowns, and people of say your age and even younger generation, they have not seen the market cycle. They have not seen 2008 being in the market. They have not seen 2013. They have not seen a lot of drawdowns. They have seen all the good part. So for them, I think very famous strategy basket is called Nifty Alpha, but with low volatility. So right now this basket is all of the companies of Nifty and top 50 that kind of take away the smaller bits, the mid and smalls, and then give you, if you see Nifty Alpha, low volatility. I'll just click here on the strategy and go to this combination. This will give you, if you open the fact sheet here,
like a basic question here, what does 30 signify? So it's Nifty
30 companies.
30 companies. So you mentioned one like Nifty 500. So was this?
So the universe is 500 there. So if you search, if you quickly see that, right? If you see here in indices and you go to strategy,
yeah, there are some 200, 550.
So
what does that indicate?
That is the universe. Nifty 200. They will screen from the top 100 plus top 100 large cap plus the next mid cap companies. So that becomes a universe to find the top 50. When you talk about say value basket, so there is a value called Nifty 500 value 50. So the universe for their selection is Nifty 500. We are trying to find 50 value companies. Now these are but single factor baskets. This is value factor. This is alpha factor. This is momentum factor. This is a volatility factor. What I'm trying to tell you is you can see there are 4 factors in one basket: alpha, quality, value, volatility. Unfortunately, in our country, there is no ETF. There is no index fund which kind of using this as a base. The industry is growing. Very recently, Mira Asset and a couple of fund houses have started the 2-factor baskets. Which is only one ETF in the country, which is on 2-factor. But there are around 10 ETFs which are on single factor, whether it's alpha, value,
and there's no more than 2 factors.
There's no 3-factor strategy in the country available. The only way to kind of participate is maybe via the platforms like our baskets, Smallcase baskets, which are multi-factor in nature. And the reason why multi-factor is important, because multi-factor historically, inception wise, if you see 10-year wise, if you see rolling return C, has beaten the base index 100% of times. Right, on paper, and of course once the products are out, it would ultimately do the same, right? So what we can do, we can think about Nifty alpha and low volatility as the good combination. This is a 2 factor. Why I'm saying 2? Because that is the only option, as I said, right, as the max available in our country to be able to participate. So you can see the fact sheet here. You can see that it is also the objective, the start objective of doubling money every 4 years. So 18%. This is again not numbers which I am plotting. This is the recent data updated on the NSE website. You can check for the same. This is only 6 months में एक बार ही update होता है. This is only once in 6 months, right? And you see right now, if you add volatility, low volatility, which means not too much of fluctuation. With alpha, the right sector right now is healthcare, where there's a lot of alpha, plus the companies are not very volatile, and that is kind of return one can expect. How do you participate in direct investments? You can go again. You can select alpha and low volatility as a underlying index. So again, there are 3 index funds: Nippon, Edelweiss and UTI, which have this, and there's only one ETF by ICICI. How do you find this information? You can again go to the same page again where you were showing alpha, low volatility, and you see there is the list. As I shown you the other side, only one fund house out of 43 fund houses in the country has issued only one ETF in the country. So that is where you can simply go to your mutual fund kind of app and buy that.
And so Robin, I think 2 examples shown here are delivering good alpha, but often high returns also come with high risk. Like, how is the risk managed here?
Yeah. So the excellent question. When you talk about volatility, right? Multi-factor baskets have proven over the last 20 years of Indian data, if you can see on the exchange, that they reduce your risk, right? You take less risk for higher returns. That is the entire notion of Nifty alpha. Low volatility is less risk does not mean less returns. So the very contrary to the kind of general opinion that high risk means high returns. If you plot it, so if you see that quadrant, you will realize that Nifty 50 might be at a volatility of 20%, 22% volatility to make that 12-13%, right? But baskets which are making the numbers we saw, 3-4% additional alpha, are at a volatility of 16-17%. To mitigate the entire risk, you can add factors to it. You can add a low volatility factor, a quality factor. It suddenly drops your volatility and still generate a lot of alpha.
Got it. No, I think makes perfect sense. Thanks for explaining step by step and breaking the myth that not all high returns come with high risk. I think
there is a risk.
balance.
So I want to clarify. There is a still equity markets are subject to market risk, as we all know. So, but comparatively, right? That is where you can position multi-factor as the right quadrant and take less risk for relatively higher returns.
Fair. No, got it. So, Robin, we spoke about how adding these few factors in your investment strategy helps you deliver alpha, and there are 6 factors, right? What do they mean, and how can I sort of understand a stock in that lens? So, for example, if value is a factor, right? How can I assess if this stock is a value stock? So, could you help explain that?
Absolutely. So we now know where is the final meat available, right? We can go once a month, once in 3 months and see the names.
Correct.
What are these value and quality? Quality would mean that it's a strong balance sheet. When I say strong balance sheet, company has very less debt, right? So it has low debt to equity ratio. Company is returning high return on capital employed. Company has high return on equity. Company is also quarter to quarter increasing the profits after tax. Value, if you see, it's more of fundamental valuation where company is available cheaper to you in terms of price to earnings multiple, in terms of price to book multiple, in terms of price to sales multiple. So all of these low P, low PB, high dividend yield companies, they are all value companies. So quality and value, of course, can be checked using screener. And what we can do, we can say go to one of the fundamental factor based indices. You can choose this, right? The one which you have something to kind of directly invest in. And if you see the fact sheet, you know that what are the index. You can just click on the sheet to get 30 names out of it and then go it once kind of 6 months, because this is semi-annual, and see that this is a kind of return, right? Which is still 3%, 4% kind of alpha over the base index. So right now, if you see higher weightage is an FMCG and IT. Now you can pick any name here. Of course, ITC, Nestle, SCL, Tech. So you search for a company. What was the first name there? What you saw?
ITC.
ITC, right? So you can pick those names, and this could be this could be a free version, I'm sure, and you can of course check कि हम पे क्वालिटी की बात हो रही थी. क्वालिटी में मैंने कहा था रिटर्न ऑन इक्विटी हाई होना चाहिए. शुड हैव गुड रिटर्न ऑन इक्विटी, हाई रिटर्न ऑन कैपिटल एम्प्लॉयड. सी द नंबर्स व्हाट यू सी. 28.4% रिटर्न ऑन इक्विटी. See 37.5% return on capital employed. That is the kind of quality balance sheet this company has. So the continuous quarter to quarter growth in terms of EPS in terms of return on equity is what define for a quality parameter. Think something on similar lines of value. This company is also valued very reasonable. So quality companies also available at a reasonable valuation may qualify both factors, right? But say take a fresh example.
Tata Motors, for example.
Check the company P right now. Is available at 8 PE, right? Yeah. It is available at much low valuation. Check the price to book. Price to book will also be somewhere here. So you see the debt to equity ratio. Price to book is just available at 2 times book.
So these parameters that you mentioned, right? So for value like ROC, ROE, like what is the range that above that it's
अगर
good?
धंधा 20% भी नहीं बना रहा, right? If the business is not paying 20%, then what is the point of that business? If you think about it, your investments can make 15, 20, 18%. Business has to generate at least 20% return on equity to be able to, you can then see that promoters are doing great job. So that could be one parameter. Of course, that would depend on industry to industry. Few companies who do a lot of research and a lot of R&D will of course have a turnaround time and will start returning that value a little later. But broadly, if you really think from a very broad perspective, I think I would see at least a 20% return on equity as a basic threshold. If you talk about value, I think there's no point buying companies which are sitting at 100 Ps. There was a period of last year where companies are sitting at 150 P, 100 P. I don't think that few sectors which become very famous like defense, railways last year were commanding huge premium. But can that premium sustain? If you ask Warren Buffett, he'll kind of tell you how value investing works, and money consistently compounding can only happen if you buy companies at the right P. Something we can also do from a momentum as a factor perspective, right? You can say pick any momentum basket. So this is a great combination of two factor, right? If you go to CAMS, you will see that this company, you see the return on equity, 40% return on equity by this company. Nearly 50% return on capital employed, still available at reasonable valuation, plus in momentum.
So good
the
mix
kind
of all factors.
These kind of companies, we say, right, how do you find multi-baggers? You don't find multi-baggers, they become multi-baggers. We have seen example of an exchange, right, BSE, the company which kind of just compounding at a rate. So this mix of quality, which is return on equity, right valuation, which is value, momentum, which is the price action in terms of higher high, higher lows, can give you, and then the NSE has done fantastic work in giving you ready-made meal. Plus, we are working hard every day to kind of curate more and more model portfolios using the same underlying principles for our retail audience.
Great, Robin. Thank you so much for sharing all of this. I think NSE has done a great job and, sort of filtering out the right stocks, and instead of just going for the top 50, top 100, if we add these few factors, I think it changes a lot of things for us. So thanks a lot for sharing this. On this note, just to conclude the conversation, you've been in finance for a long time and now you're, sort of dedicating to the factor-based investing. What's your advice for, our audience, which is usually like a salaried individual, beginners?
Since there's a lot of financialization happening, there's a lot of education by your content is happening, I think it's great that people are now exposed to the world of equity markets. It's very important that they need to realize what are their goals. Make sure that people have done these checks. There's sufficient fund available for emergencies. They are medically kind of fully covered, so that that will not create a dent in their kind of profile. Make sure that you write asset allocation. People use very simple formula like 100 minus your age, 120 minus your age to define how much equity. Of course, it could be very generic that, okay, I'm 20 year, 25 year, 75% should be equity, or I can go 120 minus 25, so I can do 95% equity. That, of course, bases your risk profile. But in that kind of equity composition, right, it is very important to think beyond traditional instruments. Think about the, these new age factor indices, what we have seen 20 years data, 10 years data. Here, the goal is wealth generation, right? Here, the goal is compounding at a higher rate. So this is the money which you have to allocate out of your equity portfolio, which you don't need now, which you don't need in the next 6 months, 1 year. You can give good 10 years to this money and kind of start in that direction. One thing which I also do and usually tell people, do not buy 10 mutual funds and think that you are diversified. You are not diversifying. You simply do not know what you are doing. You have to be very, very concentrated. One product for one type, one vanilla index, one active fund, one strategy fund. I think that's all you need.
Perfect. I think balance of vanilla, active and strategies are key takeaway. And I think the strategic funds, which are very less talked about, I think today we had a very good sort of understanding of that. And thank you so much for sharing. It's been great.